Hi, I'm Nayun.
Hi guys, I'm Xiao.
Now we are doing this presentation to introduce our project.
Okay, let's begin. There are four parts of our presentation. The first one, double moving average strategy. The second one, optimization of double moving average strategy in exponential moving average method. The third one, optimization of double moving average strategy in Monte Carlo simulation. And the final one, bar counting strategy, which is a new strategy we created. Coming to the first one, double moving average strategy. Technical analysis has been around for decades, and through the years, traders have seen the invention of hundreds of indicators. While some technical indicators are more popular than others, few have proved to be as objective, reliable, and useful as the moving average. Moving averages come in various forms, but their underlying purpose remains the same: to help technical traders track the trends of financial assets by smoothing out the day-to-day price fluctuation or noise. By identifying trends, moving averages allow traders to make their trends work in their favor and increase the number of winning trades. Among the most popular technical indicators, moving averages are used to gauge the direction of the current trend. Every type of moving average is a mathematical result that is calculated by averaging a number of past date points. The simplest form of moving average, known as a simple moving average (SMA), is calculated by taking the arithmetic mean of a given set of values. Once the values of the MA have been calculated, they are plotted onto a chart and then connected to create a moving average line. Among all kinds of different moving average strategies, our team's choice and favorite one is the double moving average line strategy. The double moving average line strategy we applied occurs when a short-term average line crosses through a long-term average line. This signal is used by us to identify that momentum is shifting in one direction and that a strong move is likely approaching. A buy signal is generated when the short-term average line crosses above the long-term average line, while a sell signal is triggered by a short-term average line cross below a long-term average line. As the chart shows, when the short-term average line MA 15 days crosses the long-term average line MA 50 days from the bottom up, it is a signal to long the stock and receive a high return.
Okay, here is a code. For this strategy, we use Quantopian as our platform. To run an algorithm in Quantopian, we need two functions: initialize and handle data. In the first part of code, we define the global variables. In this case, we only need to define the universe of the stocks that we might invest. Before trading, we focus on the basic background of different companies to find out which kinds of stocks suit their strategies. We conclude that such simple moving average strategy works best on the biggest company whose performance is very good. For example, Apple, Google, and so on. Because stocks of such companies have small volatility and always keep one tendency, up or down, for a long time, which avoid us to trade so many times. This time, we just take Apple as examples. And after we define the stock universe, we need to define the function for trading. First of all, we define three simple moving average lines whose periods are 5 days, 10 days, and 20 days. And we use the function MAVG to calculate the average of close prices for different periods directly. Secondly, we should return the number of cash in our account and the current price of the stock in order to define how many shares we can buy or sell for the stock. At last, we define the buying and selling condition, then place the buy and sell order. Look at the code. Moving average life, 5 days moving average life is greater than 10 days moving average life, and 10 days moving average life greater than 20 days moving average life. That means the stock has a great probability to go up, and in reverse, if 5 days moving average line less than 10 days moving average line, and the 10 days moving average lines is less than 20 moving average lines, that means the stock has a great probability to go down. And here is a test result. As we can see from the chart, the total return of Apple and Google is 210% and 240%. Compare the benchmark with 20.6% in the same time period. In addition, both of the two results has large alpha of 0.94 and 0.38, and a small maximum drawdown of 15% and 28%. However, we do not set adding commission and slippage. I think this is a problem of our strategies, so we will work it out later.
Okay, moving to the second part, optimization of double moving average strategy with exponential moving average method. This double average strategy is a basic model. However, we find that the average line will lag behind the stock price sometimes. The simple moving average is extremely popular among traders, but like all technical indicators, it does have its critics. Many individuals argue that the usefulness of the SMA is limited because each point in the data series is weighed the same, regardless of which occur in the sequence. Critics argue that the most recent data is more significant than the older data and should have a greater influence on the final result. In response to this argument, traders started to give more weight to written data, which has since led to the invention of various types of new averages, the most popular of which is exponential moving average. We call it EMA. We want to solve this problem by using another technical indicator which is more sensitive than the simple moving average lines, as we referred before, EMA. So we optimize our algorithm by changing the simple moving average to the exponential moving average. The formula of exponential moving average is listed before, and the coefficient alpha represents the degree of weighting decrease, a constant smoothing factor between 0 and 1. A higher alpha discounts older observations faster. Y sub t is a value at a time period t. I sub t is the value of the EMA at any time period t. So let's move into the third part, optimization of double moving average strategy in Monte Carlo simulation method. Normally, investors or traders refer to MA 5 days, MA 10 days, MA 20 days, etc. as their technical indicators. But our question is that why must be the average of 5 days, 10 days, or 20 days? Are they more effective than the average of 6 days, 8 days, or 17 days? Therefore, we apply the Monte Carlo simulation to chase our answer. Monte Carlo method, a broad class of computational algorithms that rely on repeated random sampling to obtain numerical results. Their essential idea is using randomness to solve problems that might be deterministic in principle. They are often used in physical and mathematical problems and are most useful when it is difficult or impossible to use other approaches. Monte Carlo methods are mainly used the three distinct problem classes: optimization, numerical integration, and generation draws from a probability distribution. Monte Carlo methods vary, but tend to follow a particular pattern. There are usually 4 steps of Monte Carlo. The first one, define a domain of possible inputs. The second one, generate inputs randomly from a probability distribution over the domain. The third one, perform a deterministic computation on the inputs. And finally, aggregate the results. Here is our methodology. Just like I said before, we have 4 steps. The first one is generate a time series of stock price. Then define the domain of integer a and b, which must satisfy a and b from 1 to 6t, and a smaller than b. Second step, generate numbers of different pairs of a and b, then tracking the stock price by calculate MAA and MAB. The third step, define U as a trend indicator with an initial value of 0, plus 1 to U at any time MAA bigger than MAB, and keep U unchanged as MAA smaller than MAB. Finally, based on large number of simulation of pairs of A and B, say 1,000 times, if U is larger than 700, we believe it is a buy signal and the stock have an upper trend because the shorter term trend moves faster than the longer term trend in most of the scenarios. Similarly, if U is smaller than 300, we believe it is a sell signal and the stock have a downward trend.
Okay, as for code, we first generate the stock price. We can test it by using the real stock price, but here we just generate random stock price to test. And then we define the formula to calculate the average lines. It's just like the double moving average strategies. Now let's begin the simulation. First, we create a loop for I in range 2 to 10. I is the number of times we simulate, and then we initialize the long and short indicator B and S. We create another loop to ensure M is greater than N, and if MA1 greater than MA2, the long indicator B add 1, and inverse, if MA1 is less than MA2, the short indicator S add 1.
Okay, let's begin the final part, bar counting strategy. According to the Monte Carlo simulation double average strategy we referred before, we learned that we can define a parameter which is a signal of order. If the price of the stock satisfies our buying conditions, we add 1 to the parameter. We buy the stock when the parameter exceeds a constraint number, then we buy the stock. In reverse, if the parameter is once smaller than the constraint, we sell the stock. So we create a new strategy, which detailed instruction is as below. The core idea of this strategy is to focus on the relationship of successive bars near the current price. If bars of the stock satisfied some conditions, we record it by a parameter called UD. C1, C2 to Cn is a series of the close price of the stock. H1, H2 to Hn is a series of the highest prices of every bars. L1, L2 to Ln is a series of the lowest prices of every bars. N1 is a retardation time of price after the buying or selling conditions are satisfied. N2 is a constraint of the parameter of UD, while N3 is a constraint of the parameter x and y, which we'll explain below. And we choose 4, 4, 4 as our values of N1, N2, and N4, N3. Then we have the formulas where the UD sub I means the value of UD at I bar. If the current close price is larger than the T minus 1 N1 close price, UD sub I equals to 1. Smaller than the T minus N1's close price, UDI equals to minus 1. Otherwise, UDI equals to 0. Here is calculating steps of the model's signals. First one, calculate UDI. Second one, accumulate the value of UDI. If a value of UDI is different with other value before, stop accumulating this time. Third one, the result of an accumulation equals to N2 means a start of buying signal is ready. In reverse, a start of selling signal is ready when the result of an accumulation equals to minus N2. The fourth step. After the ready for the start signal of buying signal, we define another parameter x. If the following conditions are satisfied, add 1 to x as before. Buy the stock if x equals to N3. After the ready of the start signal of selling signal, we define another parameter y. If the following conditions are satisfied, minus 1 to y, just as before. Sell the stock if y equals to minus N3. Finally, cancel the accumulation after buying or selling the stock and do these steps again.
For the code, we first define the global variables n1 equal to 4, n2 equal to 4, and n3 equal to 4. You can change the value of these two parameters according to the situations, and then initialize ud equal to 0, x equal to 0, and y equal to 0. And we want to rebalance when market opens every day, so we should use schedule function on Quantopian platform. And then we should define the my rebalance functions. First, we prepare the needed data: close price, highest price, and the lowest price. Then we accumulate the value of UD. At last, we define the condition of buying and selling, and then place the order.
So here is our presentation. Thank you for listening. See you next time.